Hello to all our participants and welcome to the Sky High Symposium 94. The webinar today is on the topic of global frameworks impacting sustainability landscape in India. And I would like to thank the Institute of Chartered Accountants and the Sustainability Reporting and Standards Board to actually bring such an emphasis on topic of sustainability, which is really growing and impacting organizations across India and globally also. The BRSR reporting is gaining a lot of importance, and the corporates are really picking up on this. So we thought it's an important topic to understand that how these global frameworks, I'm sure all of you as participants have heard of frameworks like GRI, SASB standards, and various other standards which are impacting. And we have our own India BRSR standards. So how do we work around and what is important and why it's important? So today, actually, we have an expert panel here who is actually going to help us answer a lot of these questions. And I would like to introduce yourself to one of our expert panel, which is CA Raj Malik. He is a senior executive vice president of the Reliance Group. He is an ICWA and an CA, qualified professional with 26 years of experience in finance, accounts, budgeting, costing, MIS, corporate tax, and business transformation, and various other aspects. He actually has received the prestigious Professional Achievers Award from the Institute of Chartered Accountants in 2014. He is a speaker and a panelist presenter in prestigious conventions and conferences conducted by the Institute itself or the BCAS, IMA, etc. And currently, he also manages the reporting around the BRSR for his company. He does integrated annual reporting and, as I said, does the quarterly media releases also. So I think, there's too much that I can keep going on, but I would like to welcome Sir on the call today and help everyone answer these questions. Joined with him is his team at Reliance Group, who are experts in the sustainability aspects and have a varied experience ranging from minimum 5 years to around 10 to 15 years of an experience. So I think we'll introduce those speakers as we go ahead, but I would like to welcome Raj sir on the call and hand over the stage to you to help our participants understand this concept. And just one thing, sir, before I go ahead, to all the participants, just to let you know that this session is being recorded and the presentations will be available to you when you can go and see this session. And any questions that you have on the session, please put them on the chat so that we can pick it up. And the questions will be picked at the end of the session. So welcome, Raj sir, on the session, and hands on, over to you to kind of go ahead.
Thanks, Ruchi. Let us start. Let us put the slides. Yeah, thanks. So a very warm.
Good evening, good afternoon, everyone.
Yes, madam.
Welcome, Preeti ma'am. I think it's nice to have you, and I would just like to introduce Preeti. Preeti Salve is the president of the board, and it's all the initiatives and these things are really coming from ma'am. And I would like to welcome ma'am and address the participants and hand over to you, ma'am, for your welcome note.
Yeah, so thank you, Ruchi. So I'm Preeti Saulas, Central Council member and chairperson of Sustainability Reporting Standard Board. And I, on behalf of board and ICA, I welcome all of you to this webinar on reporting. So we have with us very enthusiastic speakers, experienced, along with the experienced speaker. So we have C. Raj Malik, and along with him, the team which is joining is Samriddhi, Mithika, and Moni. So welcome the entire energetic team to share your knowledge. And a lot of things are going on the sustainability. However, it's very, very evolving things and reporting area, I can say. With this knowledge disseminating sessions, we assure you all that let us to a good level of learnings, which will really help you in the reporting part. And actual reporting is what we feel reporting is just one area. However, with that, actual sustainability is important because sustainability is as good as survival. And for being survival in now in the nation or on the world, we need to implement the sustainability in the businesses. And who other than chartered accountant who can understand well and actually get it done well to their clients. And we are actually in continuous connect with regulators so that we can support them for implementation along with the support of our board and the members, like all the speakers who are here, along with that our members and the moderators. We ensure the capacity building for our members also, so that being very new area, our members can also do well. We are also having at present 22nd batch of certificate course on BRSR, where about 200 members have joined and more than around 1500 members have already written the exams also. So this is a continuous process. So please be in touch with us, stay connected, and go through the website of the Institute Sustainability Board, where you will find a lot of material. And I can say today being the afternoon and just a day prior to our 75th uh, Republic Day, I think we can really, in true sense, we will be able to do our nation's sustainability. And with these words, I welcome all of you, and I really appreciate all the efforts of Rajbhai and entire team for being a great support to the sustainability board in all the areas. So, hand over to Ruchi and Punit Bhai being coordinating this session, and my thanks to Rangoli and entire team at our sustainability board for the wonderful work. And
Thanks,
I should
Rita.
not forget the support given by C. Sanjeev Singhal, who being the founder chairman of this board. Yeah.
Thank you, ma'am. I think your words are always inspirational to all the participants and all of us, because I think you and Sanjeev sir have been pioneers to lead not only the institute on the sustainability journey, but also get accolades for India overall. So thank you very much, and thanks for your presence today. And let's start the session. I think all our participants are eagerly waiting to hear from our experts. And, Raj, hand over to you and your team to take us through this great topic of global frameworks impacting the sustainability landscape in India.
Thank you, Ruchi. Thank you, Institute of Chartered Accountants of India and um, Preeti Madam for inviting me and my entire team for this capacity building. I can tell you, Madam, that whatever institute is doing under your guidance, it's nothing short of a great job for India, because we need sustainability professionals in India. As you know, the sustainability has taken the center stage in the corporate, which is there in McKinsey reports also. In one of the 10 most discussed item in the boards across the world is sustainability. So every company is looking for people who can lead sustainability, become a chief sustainability officer, team members. Every company is looking for assurances. So the firms are also building the capacity. So this is a fantastic way of supporting India in building the backbone of sustainability. So thanks to you, thanks to the institute. With this, I'll move on my presentation. So, madam, one thing I want to tell you. You just referred that this team has energy. Yes, this team has a lot of energy, but I can assure you this energy does not result in any emission. That is for sure.
So this kind of energy is required to sustain.
Yes, and it does not lead in emission. This offset, we need not offset or we need not do CCUS or nothing of that sort. So
This
you need not
emission
worry.
is required because you emit, others gain.
Okay, so I'll take that. Uh, So, I mean, just a very before going in, a topic is about the frameworks, which is apparently a very, very heavy topic. But for all the participants, a great relief to you. I know it's afternoon, you must have your lunch. Need not doze off. My team members will has made a presentation which is very lucid, easy to understand. And the end of the presentation, when you walk out, I believe that you will take a lot of learnings and lot of knowledge. Also, I will take this opportunity at the end to address why is sustainability important for chartered accountants. Madam has already outlined that. I will add few more words because I think ultimately chartered accountants will play a very dominant role, very important role, along with the sustainability professionals, along with the engineers, along with the HR professionals, along with other company secretary professionals in driving the sustainability in India and across the globe. Yeah. So first thing first. I mean, people who are at the initial stage of their career of sustainability. I mean, you must have heard a lot of terms: sustainability, green economy, circular economy, ESG, EHS, environment, health, safety, circularity, social responsibility, environment, social ESG, social governance, and okay, fine. So and you at one point of time, I felt that why so many terms? What are the different in these terms? And as chartered accountants, we thought of going deep into it and find out the difference of each of the terms. No need of doing all these things at this point of time, I can assure you, because that all the terms may be slightly different, but in spirit they speak the same thing. It is basically the fundamental thing is how you can present the earth which you got from your predecessor to the next generation. That is very, very important. See, we are enjoying air, water, and other things of the earth and mother nature. It is actually we have got from a predecessor, and it is our responsibility to hand over to the next generation. So this all these terms are about that. Yeah. So this ESG term is not a very it was not a very old term. It's a recent term. I think last 3, 4, 5 years it is gaining momentum. Previously, people used to call sustainability. Today also sustainability and ESG are used interchangeably. The ESG term is mainly coined by the analyst because it helps them to understand ESG or sustainability. Actually, sustainability also has three distinct verticals. One is environment, one is social, one is governance. Environment means use of water, use of air, emissions, resource, waste, etc. Social means how you treat your employees, your supply chain management, your communities, your customers, etc. And governance is by governance, we meet governance by board. So whether you have a sustainability committee or ESG committee, what is the composition of the board, what are the terms of references, how the board monitors, when what are the whether sustainability is factored while deciding the emblems of the employees, etc., etc., etc. So basically, it is governance by board governance and disclosures. Yeah. So why is sustainability important? These are the things that happen at sea levels. You all heard that Mumbai and Shanghai will go deep under sea. There will be no inhabitants. We all have our society, how society and economy will affected because some places will be inhabitable. No, people will not be able to stay. It's inhabitable, so people have to move to other places. So concentration will increase, and that will have severe consequences. Droughts and floods we have seen in India. The climate actually has changed. Devastating storm, US, India, heat waves. Well, we know what happens in Delhi and other places of India. We know that our irritating monsoons that we feel, food prices, no coffee. One of the best coffees of Ethiopia is will no more be available in future because of the climate change. The crop will not grow there, so we'll miss all coffee lovers. Bad news for them. But I can tell you something else also. Earth has faced five extinctions in the past. The first one is around 400 million years ago, then 200 million, etc. The last one was, I think, 60 to 70 million years ago in Mexico when a huge asteroid actually hit Mexico. And I think 85% of the species got extincted. I don't want to sensitize, I don't want to create fear among the mind, but it might happen that the sixth one is on the cards and we are all playing role to have the six extinctions. We chartered accountants, if we under sustainability, we should play a role in our nation. Maybe we will try to push it a bit forward. Otherwise, at this point of time, in my opinion, extinction is very much there after I don't know how many years. but it will definitely happen the way temperature, climate change, etc. happening. Yeah. So where is India? Well, if you see the if you see this graph, if you can see China will being the absolute in terms of absolute emission, China being number one, US being number two, entire European Union is number three. But if you see country per se, because European Union means many countries together, if you see country per se, India is number three. So bad news for India. India is the largest emitter. So well, India is a bad boy. But if you see annual carbon dioxide emission per capita, India is only 1.8, where the world average is around 4. Compared to that, US is 14.9, China is 8, European is 5.9, Russia is 12. I think Canada is also very high, around 14, 10, 12. UK is around 9 or 10. I remember that. Okay. So means India per capita, each of the person, whatever per rata emits, it is actually quite low. But since in India we have a population which is we are one of the highest populated country, so our total emission is high. So that way, if you see that we have every reason to be proud of whatever we have done. India, in Indians, we know that we have always believed since inception, since in the past also you have seen that with minimalistic living, we don't have luxury. I remember in my house in our days when I was young, my mother used to wear a sari. After wearing few times, she will give to someone else. Maybe some poor people she will wear. After that, the sari will be torn apart and used for many other purposes. So recycling is not a new concept in India. What West is teaching, recycling. It was never a new concept in India. India used every material to the last part of it. In the entire culture of India, entire literature of India, if you see, speaks of minimalistic living, simple living, and apart as against the luxuries that is preached in the West. So that's why. So India has never been a problem child. Yes, our population is more, absolutely, that's fine. But India has never been a problem child. Yeah. But we have never been a problem child, but definitely we're part of the problem. So thanks to our government, they have taken very strong steps, very bold steps. As per performance and sustainability is concerned, India is top 3 or 4 countries. What we perform, what you've committed, we deliver what you've committed. That's what I think as contrast to other developed nations. So basically, our honorable Prime Minister have announced net zero by 2070 means emission in India will be zero by offset method or by CCUS by 2070. It means simple terms, by 2070, India will not add any more greenhouse gases in the environment. But if it adds, some way it will take it back also. So net addition will be zero. That is what net zero means. So there are 5 steps, which is called Panchamitra, non-fossil energy capacity 500 gigawatts. So you must have heard by PM, must have read in several newspaper articles that non-fossil energy capacity will be raised to by 500 gigawatt by 2030. And I'm proud that my company is also contributing to it. Our plan is to actually raise it by 100 gigawatt by 2030. So we will contribute to the at least 20% of the ambition of that India Prime has. Meet 50% energy requirement by renewable energy by 2030. Again, that's a great thing. We know we have coal, we know we have fuel, petrol, liquid fuel, but we have promised, we target to meet 50% energy requirement by 2030. And the way things are moving, it appears to be realistic. Reduce total projected carbon emission by 1 billion tons from now onwards to 2030 means every year the carbon emissions will reduce by 1 billion tons to 2030. By 2030, they reduce the carbon intensity by economy of less than 45%. I mean, that's a huge number. I mean, almost 50%, half of the intensity reduced by half. That's a great thing. But let's see what happens. And I'm very optimistic with the various policies the government is taking, the various measures the regulators are taking. We will definitely reach there. And the ultimate one is 2070 net zero. By 2070, India will not emit any greenhouse gases in the environment on net basis. As against 2070, our company, I'm very proud to tell you, our company has a very ambitious target of 2030. 2035, sorry, 2035. So I think we are there, and there are other corporates also who are going ahead with that. So with this, I want to tell you that now will come the heart of the session. If you're the CFO or part of the corporate team, or you are other side of the table, the auditor, one of the questions that comes to your mind is there are so many frameworks which one to follow. Again, that I mean, we CFOs are really get bothered by that, bogged down by that. Thanks to our SEBI, they have mandated BRSR for top 1,000 entities for 2023-24, and this is only one country that has mandated for his corporates to have a mandatory framework. None of the countries, whether US, China, UK, none of the countries have such a system. So that way, definitely we're going ahead. But one of the headaches that the CFOs had previously is not there. But nevertheless, to be global, if you are following any framework, which framework we follow? It's a very important question. It's a very interesting question. And for that, I will first move to our team member, Samriddhi. Now, let me introduce Samriddhi. Samriddhi is a rank holder, gold medalist from NITI, and she is a sustainable professional. She is working. Was working at Tata's, and since last year she is working in my team. She is a very important member of the team. She is hands-on. She has done the audit. She has worked extensively as her. So over to Samriddhi to take us in the next section of the presentation.
Thank you, sir, for the kind introduction and how you started the presentation. Let me start with one of the oldest framework that came into picture. So we'll start with the global framework that has got implemented and how companies started using that on an initial basis. So in 1977, before that, there was no standard framework or guidelines where companies could report on the sustainability data. You only had your annual reports where you could see the financial information, but nothing could be understood whether how you're impacting on your other non-financial parameters at economic, environmental, or social parameters. And that's when in 1977, GRI, that is the Global Reporting Initiative, came into force, and they set up a guidelines where it became easy for the companies, countries, corporates to report on their sustainability data and what is important for their non-financial parameters, so that their stakeholders could understand how the company is performing on these aspects. So it is the oldest one and has been widely accepted by almost all the countries. More than 100 countries are reporting, and there are more than 10,000 reporters across the globe for GRI. And this GRI, when it was introduced, it went into a lot of changes. We'll see how it is currently. Today, it is a set of interrelated standards, and it is divided into 3 sets. That is the first one being the universal standard, sector standards, and topic standards. I would just give a brief on each of what these mean, just to have an understanding of it. So the universal standard is the one that gives a general guidelines of what GRI is, on what principles it is based, and what is important for GRI in that parameters. So, and this is applicable to all the companies. So any company that decides to report on the sustainability data using GRI has to have this on their revelations on the universal standards. So the universal standards, the second part about that is the disclosures about the organization, which means what is the organization all about, their activities, their governance structure, their policies, basically just to give a brief intro about how the organization is working and what are its products, services, or outcomes that are coming from the organization. And the third part of the universal standard is to identify what material topics are that are significant or important for the organization. Now, what is materiality in short is basically what are those aspects of the company that are most significant or significantly impacting to your economic, environmental, and social parameters, including your human rights as well. So not just financial parameters, but these parameters also important to the stakeholders, and that is you have to identify which are the most significant ones among all of these, and then you have to report on these material topics. So these become basically your material topics or the significant aspects. And then this is all about your universal standards. Moving on to the second part, which is the sector standards. Now, these sector standards have been very recently developed from 2021 onwards. Prior to that, we had only topic-specific standards, but these sector-specific standards are more focused on to wherein GRI has readily identified the material topics for each of the sectors that are there. For example, your oil and gas sector, your mining sector, your coal sector, agricultural sectors. So this is a very good thing wherein you are not just reporting on what you feel is material, but as an industry perspective, this is something that you have to report because you are operating in a particular industry. For example, if you are in a coal industry, your air emissions, your GHG emissions, your land, your biodiversity, everything gets affected. And if you are skipping any of this, that would mean that you are not reporting on a substantial basis. And that is why sector-specific standards have come into picture. GRI is currently developing a lot of sector-specific standards. They have planned to develop around 40 standards. And up till now, they have released 3, which is on oil and gas industry, coal industry, and your agriculture, aquaculture, and fishing industry. So this is all about your sector standards. And the third one is now, which we move is the topic standards. Now, topic standards are grouped into 3 sets. The set of 200s, which is called as 200, 201, 202, is all about your economic topics. The set of 300 is all about your environmental topics, and set of 400 is all about social topics. A short what about 200 means economic topics. That means your taxes, your anti-corruption, your anti-competitive behavior, how is the economic performance. All this forms a part of your economic topics. Now, each of these have their own questions, and GRI also provides guidelines on how you can report on each of these economic topics and the requirements that they have provided in it. Similarly, the next one is environmental topics, which tells you about your air, water, land, emissions, waste, etc. And your social topics is all about your employees, your customers, your suppliers, how you're taking care of them, the policies for them, how you're making sure your occupational health safety standards, everything about, and your customer privacy and so on. So this forms a group of your social topics. So this is a general brief purview of how GRI had come into picture and how companies are still reporting onto GRI. In fact, it is one of the most widely accepted standards. Now, though we know about GRI, there is one more standard that has come into picture, that is one initiative. What the problem with GRI was that it was more focused on sustainability standards. Now, we had 2 reports. One was for annual report, which was focusing on your financial data, which was more for the shareholders of the company. And there was another report, which was then coming out as a sustainability report, which was based on the GRI parameters. So, which was for the other group of your stakeholders, that is your customers, suppliers, employees. So there was no interconnectedness between your financial reports or your sustainability reports. That is when integrated reporting, the IR framework came into picture. And now this is majority of the companies have even started adopting integrated reporting along with your GRI reporting. What IR has done is basically it has connected your financial information with your other information, that is your economic, environmental, social, is also combined into this integrated reporting framework. So it's not just about reporting. What they have done is they consider an organizations as a value chain, value creation model. So in this value creation model, it's basically focused on how, because of your operations, whether your organization is creating value, it is preserving the value or destroying the value in the long term. So it's just not simple question answer type of reporting, but a complete value creation model which focuses on 6 capitals. So the first capital being financial, which focuses, like, it's a part of your annual statements that you can, financial statements. The less capital, 5 capitals, which also add value to your organizations are the manufactured capital, basically your assets, your equipments, your plants, which you are having, your intellectual capital, like your patents, your copyrights, etc. Then your human capital, which is the most important one, which includes your employees, their training, their skills, their competencies. Then you have your social relationship capital, basically your bond and connection with the communities in which you operate. And the last one is natural capital, which is how you take natural resources from the environment for operations of your businesses. In this model, it focuses on how, because of your governance strategies, how your performance and outlook, and because of the outputs that come into how this affects your financial, manufacturing, intellectual capital. Now, IR not only focuses on your shareholders, but it includes your customers, suppliers, your communities, your policy regulators, and your other general public as well. So the benefit of integrated reporting, apart from GRI, is that gives a complete bird's eye view to all the stakeholders to understand your company, both in terms of financial aspect and the other aspects from in the ESG parameters, and how investors then it can invest in the company not just only on the financial perspective, but seeing the long-term sustainability, whether that company is going to actually be sustainable in the long-term future because of whatever shortage of resources or the current situation of climate change is happening. And that is how integrated reporting has helped us. So we have now looked on to two major global frameworks. And I know Raj sir has already spoken about BRSR, but I would still, after this global framework, I would like Raj sir to speak on BRSR, a short info about it.
But thanks, Amriti. Thanks for your presentation. Now, what is BRSR? First of all, BRSR stands for Business Responsibility and Sustainability Report. It was mandatory for the financial year 22-23 for top 1,000 entities with market capitalization. It is only framework that is mandated in India by our regular SEBI, and is the only example of such framework is in India and none other in the whole world. So that's very unique. Now, if I have to if we have to speak of BRSR, it consists of 9 principles, and each of the principles actually covers one of the areas of the sustainability, whether it's customers, whether it's vendors, whether it's natural emissions, etc. But we have Mitika Bajpayee with us. Mitika is an engineer from Bombay University. Then he did her master's from Columbia University. She is fortunate. She has worked in sustainability for more than 10 countries before she actually came down to India, settled, and she's in our team for last 7 years or so. She is a very known professional in the sustainability world, and a lot of you must have heard her on some phone. I'm very sure. So without wasting any further time, I'll hand over it to Mitika now. Mitika, all yours.
Please unmute, Mitika.
Mitika, you're on mute.
Am I audible now?
Yeah, you are.
Okay, great. Thank you so much, very kind. I think, firstly, we are very fortunate to be working in a team where everyone has equal appreciation for each other, which is very rare. So yes, we all feel very fortunate for that, and that also reflects on the kind of work we do, or can do because of that. I think SDG is before this, right? What is SDG? Right. So far, what we've done is we've covered two key frameworks, and coincidentally also it's been historical. So GRI has been around since forever. IR came into picture in Indian context in 2017. And as Sir mentioned, BRSR came into context right after that in about 2021. There are a few other frameworks that have been around, sort of underlying, like the Sustainable Development Goals, and what is upcoming, which is the IFRS Sustainability Standards on S1, S2. I'll just touch upon both of those, and then I'll also leave you with a few other frameworks that would be more specific to certain industries that one could look at as well. Now, the Sustainable Development Goals were actually sort of sustainability-focused goals that about 192 countries signed officially at the United Nations in 2015. I was one of the few lucky ones to be present in the UN office in New York to be able to see this signing, and I can assure you the environment was ecstatic. Right before SDGs, we had another similar set of goals for another 15-year time frame called the Millennium Development Goals. And for about almost 3 years before the Sustainable Development Goals were signed, there was question about why or what aspects of the Millennium Development Goals had failed, right? And what was the failure from that was incorporated into creating the Sustainable Development Goals, which is why if you actually compare the two set of goals, you'll see not only are they sort of broadly in the same line in terms of where the countries together want to move in the context of development, both economic development and socio-economic development. The key difference is that these Sustainable Development Goals are further broken down into targets, right? So there are 17 goals which are further broken down into 169 targets, and each of the countries that have signed on the SDGs have agreed to measure progress on these targets and disclose that publicly year on year. Right, which is a huge commitment. So it's not just talk saying that yes, we're going to eradicate poverty or we're going to move towards a no poverty system within the country. It's actually measuring progress against certain quantitative KPIs, saying how are we going to get there and what is the difference year on year in terms of how we're getting, which is very fascinating. And you can see all of the progress of every country has a different system of doing it and also customized in the language that is more appropriate for the country. One such forum or online system where you can check this out is SDG Tracker. That is tracker.org and .com. Depending on the country you're in. What it does is for each of the goals that you see here, right from no poverty to the 17th month, which is partnership for the goals, against each of the 169 targets, the countries have disclosed their performance, right? So in terms of, say, for example, climate action, they've talked about, the absolute emission slide that Sir talked about earlier, also mentioned earlier in the session. The climate action website, that's number 13 on the SDG tracker, has the exact same numbers available. And it's also linked globally to a world data tracker, which again measures everything right from census to your economic performance, to your production, to your import-export, to your climate performance, to your renewable energy production. All of those are sort of linked in some form or the other to data. And that is the key sort of differentiator for why these goals are different from anything else that we've seen in the past. Now, the SDGs have also become sort of a everyday conversation, be it in schools, be it with youth organizations, be it with companies. A lot of companies also publishing a separate CSR report and an SDG report, wherein they're talking about initiatives, not just that the company is doing, but also that they are doing in collaboration with other NGOs, with trusts, with their CSR arm, with their foundations. So it's a mix of both in terms of what is it that the company is focusing on and where is it that they can create an impact. Say, for example, one of the most common SDGs that a company can create impact in is possibly affordable and clean energy or climate action, or sustainable cities and communities if they're in the construction space, and of course in terms of responsible consumption and production if they are in the manufacturing, FMCG or production space. So and then for the remaining ones, you can see a lot of the CSR initiatives that will create drive benefit. Of course, here in the agricultural sector, you'll see a lot of these natural resources directly impacting your business. So there's a very strong correlation between what businesses are reporting, what countries are reporting, what not-for-profits are reporting, and SDGs become sort of a holistic framework for all of these different partners to come together and collaboratively try and create an impact. Which is why SDG is not essentially a framework, but it gives you key indicators against which you can collaboratively measure progress. And it also, of course, gives you an opportunity to work with more than just your peers in the industry. Right. So, and lastly, just want to quickly mention it's based on 5 key focus areas, that is people, planet, prosperity, peace, and partnership. So the 3P concept is something that everyone had heard of. SDG is brought together the 5P concept, which is just sort of an evolution of the 3P concept. Now that you've understood the history, what is now happening is, with all of these frameworks, BRSR, what it did is it picked up the key frameworks from world over, which at that point were SASB, SDGs, GRI, TCFD, Task Force on Climate-Related Financial Disclosures, which we'll touch upon as well later, and then created the Business Responsibility and Sustainability Report Framework, which gave us a comprehensive list of 145 questions, which helped us measure progress in a very similar manner. What is happening now is you have, as I mentioned, Indian companies have created a framework, but globally there still needs to be a consistency across frameworks for us to start reporting on it and to measure comparative companies in the same breadth. Say, for example, we shouldn't be talking about the US and UK and India in a different sort of reporting framework just because even if they're in the same industry. So organizations like IFRS have come up with a sustainability standard called the S1 and S2 standard this year, and they're considering launching more standards in the future. This slide just briefly gives you a summary of what to expect in the IFRS S1 S2 standards. This will be in effect, the S1 S2 standards were introduced in June last year in 2023. They will be in effect for reporting starting calendar year 24, which means the first round of reports will be available early 2025. Globally. Now, S1 and S2 are essentially divided by two key word differences. S1 is asking you about sustainability related risks and opportunities, and S2 is asking about climate related risks and opportunities. But both S1 and S2 are further divided into four broad segments, that is governance, strategy, risk management, and metric and target. These four sub-segments are also actually very similar to what TCFD is asking for, that's Task Force on Climate-Related Financial Disclosures, except that that's only solely focusing on climate aspects. Now, within S1 and S2 standards, there are about 50 plus disclosure requirements within S1 and similarly 50 plus disclosure requirements within S2. And of course, you have a time frame over which you can progress on your reporting. But what it's asking you about, the kind of questions within, say, governance would be about who is the board personnel responsible to be able to measure sustainability related performance. If you have a person or a committee, how is it that they are getting awareness about sustainability performance? Do they have the skill set to be able to contribute actively towards sustainability? And of course, beyond the board level, who at the management level is looking after sustainability? Do they have the skill set to be able to look at sustainability related information and actually draw analysis and create decisions? What is your decision-making structure in the governance structure that is focusing on sustainability or climate related risks and opportunities? Similarly, within strategy, they've also further broken it down into four broad segments, wherein they're not just talking about strategy from a business model point of view, but also a value chain point of view. So business model is something similar to what Samriddhi described in terms of IR, integrated reporting, wherein what is it that you're doing internally, considering the external market forces. Within value chain, you're not just looking at what you're doing internally, you're also looking at your suppliers, customers, and any other vendors and partners, including subsidiaries in this context as well. So it's a much larger focus area beyond your core business, but also your entire value chain, which is interesting. Within strategy, they're also asking questions about decision-making strategy, or your mitigation strategy, or financial resource deployment strategy. What are the risks? How do you go about strong management systems internally to ensure that your strategy is effective and you're measuring the right progress indicators to be able to use? Within risk management, they further divided it into the kind of risks you will be monitoring, not just in terms of time frame, that is short, medium, and long term, but also which physical locations are you considering in terms of risk management. Now, risk management is also asking you more pressing questions, saying that, okay, once you've identified the risk or an opportunity, what are you going to do about it? In the sense, how are you ensuring mitigation, resilience, and adaptation? All three. And all three are not technical terms, so we won't get into extreme details here, but all three are extremely different from each other, which is why your strategy to be able to manage each risk should be very different from each other. So you're not just, say, for example, just a very quick example, mitigation would be, say, for example, how do I, like a net zero target would be considered a mitigation action. How are we making sure that the GHG emission rise can be curbed and the impact of sea level rise in that case on my financial assets will be lowered, right? An adaptation strategy, for example, would be how do I create a sea wall to make sure that the sea level rise does not impact the facility that is closest to the sea. right? So the two strategies are still going to help you solve the same problem and are still addressing the same risk, but have completely different execution plans and have completely different time frames for execution and measures of success in this context also. One is more reactive, the other is more proactive, but it depends entirely on what stage you are in terms of your financial assets, of your capital expenditure, of your business performance, wherein you should consider all three equally. And then lastly, they talk about metrics and targets. Again, metrics and targets is further broken down into timelines, into interim targets, into absolute targets and intensity targets. It is talking about which KPIs that you should be measuring. Now, IFRS S1, that is sustainability related, is not focusing on, say, sector-specific sustainability topics, but they have touched upon the concept of materiality, which in this case is actually very similar to what GRI has also interpreted, but of course it can be open to interpretation depending on the sector you're present in, right? So sustainability related risks and opportunities, your metric and KPI against each of the sustainability parameter that is material to you would be slightly different. Whereas in S2, because it is climate specific, your KPIs are more straightforward and they've referenced GHG protocol for you to be able to elaborate on your metrics in that context. GHG protocol essentially breaks down your GHG emissions into three broad scopes, that is scope 1, scope 2, and scope 3. That's also something we will briefly touch upon on the next slide, but just to give you some context here, it is scope 1 is essentially what you call as direct emissions, scope 2 is indirect emissions, and scope 3 is other indirect emissions, in the sense that something that will come possibly from your value chain. Now, so far you've understood quite a bit of the history in terms of, three key frameworks that have come up so far, and one that is upcoming that you'll see more reporting about next year. But let me also tell you that there are several other frameworks at any given point. Before VRSR, we in India used to look at about 15 plus frameworks. This slide is just talking about a few of the other important ones that you could consider depending on the sector that you're present in. The first two, sort of the World Economic Forum's stakeholder capitalism metric came into effect about 2 years back in 2021, wherein multiple different consulting firms came together with the World Economic Forum, with the industry participation, with global industry bodies being represented, and they came up with trying to solve for the framework soup challenge. Right? Considering there were so many different frameworks, they also wanted to try and find a way to say that, okay, these are some of the key parameters that an investor or a stakeholder externally should have about a particular company to be able to make wiser decisions or engagement platforms with that company. Now, this is also further divided into four sections, that is people, planet pillar, people, planet, prosperity, and governance. And that's further broken down into a few questions in terms of core and comprehensive that you can report on. Now, one of the key segments within the World Economic Forum stakeholder capitalism metric is to comply with TCFD, that is Task Force on Climate-Related Financial Disclosures. Now, here the perception is that anyone who's reporting on sustainability must also find a way to report on their climate performance, in the sense not just their GHG emissions, but also their GHG emission reduction trajectory. How are they making sure that their emissions are reducing year on year? And when is it that they'll be able to reduce it significantly such that the impact on their financial assets is the least possible? TCFD is also asking for financial impact and of the risk of climate change happening to you. And not just talking about the physical risk, but also the transition risk. In a sense, what would be the impact of, say, the energy transition on your company? What would be the impact of just transition of the energy transition on your company? In the sense, what is the social impact also within your company? Are your employees skilled enough to be able to adapt to the new energy transition? What will happen to the employees that are nearing retirement, and how are you going to prolong their careers in an age where everyone would probably be living a much longer life than our grandparents did. So all of those factors are to be considered within the first two frameworks that you see on the left of the screen. You also have three other frameworks on the right of the screen talking about SASB, wherein a lot of the sustainability accounting standards board conversations have been merged within IFRS S1, S2 standards, but it's a way of integrating financial information with non-financial information. Specifically in this context for US-based companies or companies that want to do business with the US in this context, but it is part of your Form 10K there. So it's part of your annual report. Now, it doesn't necessarily need to be presented like a report. It could also again be presented as a question and answer format, but that's a sort of stance that a lot of companies have taken, that we've seen US companies take. So yes, their reports are not as vibrant as Indian company reports that you see in the sustainability context. And then, of course, you have the remaining two frameworks, which is United Nations Global Compact and United Nations Guiding Principles on Business and Human Rights. There is a UNGC and UNGP. These are United Nations frameworks because something was needed for the social aspect. So for human rights and for the social considerations beyond employment, it was very crucial to have a basic sort of benchmark that you could ensure across businesses world over. So UNGC and UNGP have tried to set such frameworks. UNGC has sort of a guideline that you can follow. UNGP has 10 principles against which you can measure your performance and ensure that you have the right policies and governance structures in place to be able to make sure that no slippages in the context of human rights happens within an organization. Now, other than frameworks and standards that we've seen so far, there are three other types of reporting guidance that you see in the industry, right? One is a protocol, which is in our case the most commonly addressed protocol is the greenhouse gas protocol. Now, what is the difference between a framework or a standard and a protocol is that a protocol is essentially guidance on how to measure a very specific KPI, whereas a framework and a standard help you compile a different set of KPIs that a company should report on, right? So protocol then essentially becomes a underlying document basis which you do the calculations that you need to report on. In this case, the greenhouse gas protocol helps you make consistent some emission factors that you need to be able to monitor. Even within scope 1, that's further broken down into, say, 6 key emission types. So that's, GHG is further broken down into multiple different gases. One of them is methane, one of them is carbon dioxide, one of them is nitrous oxide, and so on and so forth. Now, for each of these, how do you do the calculation? What is the emission factor you should consider depending on the country you're in? All of these more technical details are available in, say, a greenhouse gas protocol, and they tend to update it as and when there is significant impact on the environment. So, say every 2-3 years, they try and update their emission factors, and their guidance sort of remains the same in terms of what is the categorization of scope 1, scope 2, and scope 3. Then you have another set of, industry supporters, which is your questionnaire type, wherein a Climate Disclosure Project, or CDP, or the popularly known acronym, has questions regarding, say, climate change, regarding water, regarding environment. Now, these are an exhaustive list of questions that the CDP forum is asking companies to fill out. They evaluate the company on these questions and give the company a score. Now, questionnaire type is also very common in the rating agencies, which was again one of the framework slide that we'd seen earlier today, that Chancellor touched upon as well. CDP is one such questionnaire that focuses on key focus areas that are in the environment space. There's also organizations like Dow Jones Sustainability Index, that is DJSI, that focuses on a few other rating agencies that go beyond environment, wherein they're touching about social and economic parameters. And then lastly, you have something called a registry, right? Which is the one that we are also probably moving towards, right? So it's not just about getting the data, giving you a scorecard, or getting a number that we might find helpful, or a comparative number, but it is also to make sure that the data sent through these scorecards and through these frameworks is consistent and can be used across the value chain, right? So in a registry format is when you start including your value chain, which is what the EU is trying to do right now. But of course, this is sort of a more, it's a more global process. So this will probably take a little longer than is currently being discussed. So the carbon border adjustment mechanism is something that's coming up, and most of the companies that within the 6 sectors that has been laid out by the EU will probably be impacted while doing trade with the EU. Which means when you are doing trade with the EU, that's the European Union, you'll also need to give disclosures regarding your carbon performance, which means your GHG emission performance. And then the EU will be at a liberty to choose which companies or which countries they would prefer to do business on basis your emission performance, which is still a debate in the industry as to how would you do a benchmarking like this and without marginalizing a few countries. But there is the idea is to share data in a uniform manner across different agencies. A registry is also a performance or a tool that the Indian markets are using in the context of carbon emissions or carbon trading, which is also an ongoing conversation. On that note, I'll just probably stop and ask Radha to come in and take away from our technical details.
So thank you, Deepika. Thanks for this session. I mean, it was really very informative. So after we've heard these frameworks, I want to ask you a question. And let's see how many of you have heard this. Have you heard of greenwashing? I mean, okay, well, it's a one-sided webinar. So I presume that some of you must have heard, some of you may not have heard. But greenwashing is getting predominance. Greenwashing is gaining importance. And greenwashing is something that we should all understand. Otherwise, we will fall prey to misleading information by the corporates and other agencies. So greenwashing takes the center stage. You know, when so much data is required to be provided, required to give the public domain, and those data will be taken by the general public. So unless we understand greenwashing, unless we understand the impact of greenwashing, we will be having a false impression, which is not correct. So thus, since regulator is pressing for data, corporates are bound to give data. So we need to understand greenwashing to differentiate between the data which is subject to greenwashing and which is not subject to greenwashing. For that, we have Muni Bajaj in our team. So I've been talking everywhere that the chartered accountants has to play an important role. And look, today we have a chartered accountant, young chartered accountant who has decided to move away from the conventional areas, direct tax, indirect tax, accounts audit, and plunged into a career of sustainability. Moni, all yours. And to introduce, he's a chartered accountant. He's working with us, Associated Reliance, and she's working in the ESG space. So Moni, all yours.
Good afternoon. Good afternoon, all. Thank you, sir, for this kind introduction. Well, I don't want to waste time. So, my colleagues already, talked about various frameworks of ESG reporting. Now, I want to highlight why this ESG reporting is. Frameworks are required because a lot of companies, first of all, don't know what to report, and they are under so much pressure, that they should be environmentally sustainable, they should be socially sustainable, and for that they do something which is called greenwashing. We all, financial professionals are aware about the window dressing thing, that when companies provide misinformation and manipulates the accounts to show that their financial situation is very healthy, but actually, which is not true. So, in greenwashing, companies try to report something which is not true, and they try to sound sustainable, but they are not. So, in greenwashing, companies creates false impression of their products, environmental virtues, deceiving stakeholders through misleading claims and imaginary. They shows that their operations are sustainable. So by doing that, they breach the trust of the stakeholders. So there are some common greenwashing tactics which companies use for misleading their reports. So they use vague or misleading terminologies, like they say we are environment friendly, but actually they are not. the they are emphasizing one small aspect, like highlighting a known environment friendly aspects. Green labeling, we have already seen many companies, they in their on their products they say that they are eco-friendly, but actually they are not. So using labels without substantial evidence or adherence to comprehensive environmental practices is called comes under the greenwashing tactics. Then there is lack of transparency, withholding specific information about environmental impacts, plans, and progresses. They don't share the confident. They consider it a confidential data, but which makes it misleading. Then there is false certifications. Many companies show that this and that agency gave them certificate that they are environmentally sustainable, but actually they are not. And there are a few more examples provided by ISSA 5000, which is International Standards on Sustainable Assurance, which is only a draft, but expectation is that it will come by the end of the year. So they also have stated some examples of misstatements due to fraud in sustainability information, like for example sustainability information to avoid penalties and fines, and intentionally inaccurate or misleading public statements or claims that will favorably impact their prices, or as an assessment of the entity's sustainability credentials, such as an inaccurate statement that a bond is sustainability bond but which is actually not. So there are more examples there. uh, Now, I want to talk about the real examples of greenwashing. So, there is a company, Denimar Scientific. In this, the company claimed that they use a biodegradable plastic, but they create a biodegradable plastic, but then it came that it is not a biodegradable plastic. So, it was a false claim by the company. H&M consumers also filed a lawsuit against the company that they said their products are environment friendly, but actually they were not, because you have seen there was a report in H&M products. Their label, on the label it was written that it is eco friendly, but later it found out that only the label is eco friendly and recyclable, not the main product. FIFA also got criticism over its claims of carbon neutrality. It said that the organizers said that they managed everything in a sustainable way, but actually it was not. So, they have already faced a lot of criticism worldwide. In DWS Bank, there was also potential fines for misleading sustainability claims. The bank claimed that their sustainability products were more eco-friendly and socially friendly than they actually were. In Godrej, they claim that their soap is environment friendly and contains biodegradable thing in that, but actually it was not. So they, I think around 5 lakh rupees they got fined from the controllers. In Voltas also claimed that their product is very much energy efficient, it saves energy. That also was not true. IKEA got greenwashing uh, greenwashing in IKEA. The allegations were like they imported wood from protected forest from Russia, and so these are the all examples of greenwashing. Now, I would like to tell what are the consequences of greenwashing. Like in financial statements, we already know that there are different controllers who controls that whenever you do any manipulation in the financial statements, you will be fined, you will be penalized for that. But in greenwashing also, if you manipulate your information related to your sustainability claims, there are also some severe consequences which the companies can face. So penalties and damages. Like I said, there in the previous slide, I told there were companies which already faced the criticism, and some got fined also. So fines and penalties and damages are is one of the consequence. Another is loss of revenue. We all know that the customers nowadays are very much aware, and the sustainability thing is on rise. Everybody cares for the environment and society. They want to know the product which they are buying, where it is coming from. And if the company is doing greenwashing, they will avoid to buy that product from the company, and thus it can cause loss of revenue to the company. Financial setbacks. Of course, if consumers not gonna buy your product, then there will be loss of revenue, and then definitely financial setbacks. Legal liabilities, like I already told, the companies may face lawsuits, and because of that, there will be legal liabilities. There can be legal liabilities. Reputational erosion. As I said that nowadays there are consumers which are very much aware, where they want to know how companies doing their business. There are many organizations also, like non-profit organizations, which actually publish reports, that this company has done this non-sustainable thing. So it can cause reputational damage to the company. Regulatory scrutiny, of course, if like in financial statements or in income, like we have seen income tax cases also. Once you got you caught in some case, then they will be after you. There will be regular scrutinies. So same thing can happen in greenwashing cases also. uh, Environmental group criticism, like I already said, in reputational erosion, there are many environmental group. I think from last few years we are hearing about so many strikes happening worldwide. Like there was a girl got also awarded for her actions for climate change. Her name was Greta Thunberg. So there are many environmental groups which talks about how the companies are not operating properly. They are causing environmental disbalance, and it is not friendly to the society living around that particular uh, plant or factory of that organization. So what can we do in that? There's there are a lot of assurance requirements are coming up, like my colleague already told. So we have to be vigilant and promote transparency, and we chartered accountants can play a big role in that. We can provide assurance about that the about the claims. I think now, so that's all, sir. I would like to tell sir to.
Fantastic, ma'am. Yeah, that's it.
So, thank you, Muni. Thank you, Muni, for educating us on greenwashing. So, you have raised a very important question, and you ended with a statement, which today I feel is a $1 billion statement, that chartered accountants need to play a key role. Well, apparently, if you go to any corporate and if you see where a chartered accountant in the sustainability play, you will hardly find them anywhere. But things are changing. Now, let me try and explain why things are changing. Now, who is the person who is responsible uh, for the accounting and for the financial accounting and the results? Who is the person who is responsible for auditing? Who is the person who is responsible for depository of data and maintaining a credible system? Who is the person who is responsible for raising finance? Who is the person who is responsible for maintaining a positive thing in the minds of the investors? Okay. I mean, the answer is very simple. The CFO, Chief Financial Officer. If the Chief Financial Officer is responsible for all these things, then how can he run away from sustainability? Today's Gen Z thinks more about profit or considers profit less important than the perception. So for perception, analyst, well, they are actually very seriously pouncing upon the corporate on the sustainability. I can tell you that from my experience, I've been facing the analysts for the last 10 years. And 5 years, even 2 years back, also analysts used to come ask all questions of profit, EBITDA projection, new business, and then at the end of the session, maybe one or two questions, one routine question of sustainability. Now every month, one or two of the such focused meeting only on sustainability we have to address to the analyst community. So that's what the pressure is. There are many fund houses. BlackRock is a typical example where the CEO has already writes letter to all the CEOs and CFOs. Until you follow the path of sustainability, will have your consequence. He openly tells it's a challenge and it's an opportunity. Opportunity. So you decide which one you want to take. Whether you will meet the challenge and take the opportunity, or you will stop funding it. In fact, there are various fund houses who sees the data. There are rating agencies who suo motu does your rating, and that has a lot of impact to play on this analysts and shareholders. Shareholders have even started asking questions. Regulator has also joined the bandwagon. So if all these things have to be done, now who are the person responsible? Obviously, we need sustainability professionals to carry this on because they are the person who have been taught sustainability. Till now, in CEO curriculum, the new curriculum which will be there, we don't have any sustainability. But what we have is we know how to be a depository of data. We know how to get the data audited. We know how to maintain the audit trail. We know how to maintain the credibility of data. And to with all fairness, the accounting community, the finance community, has done a fantastic job over the last many years to maintain the credibility and sanity of the data. So if they are the person who does that, of the financial data, how can they say, awards, we are not interested in the sustainable data? Because my understanding is today, if you see any annual report, maybe 70% data is financial, 30% is sustainability. With this BRS has slightly increased, but over the years to come, many experts feel that 70% data will be on sustainability and 30% data will be financial data. So who can manage the data, who can manage the investors, who can raise funds at the cheaper rate? Well, the CFOs. And I think the sustainability monkey will firmly sit on the sit on the shoulders of the CFO, and then they cannot get it off. But of course, it's a team game. You need sustainability professionals, you need HR professionals, you need technology professionals, you need company secretary professionals, you need business people to in the sustainability. One very important role which young professionals, not only chartered accountants, any young professionals need to have is a sustainability mindset. So yesterday, I think few days back, I was addressing to a lot of deans and principals. It was a session conducted by government as well as ICA in joint collaboration. So there, I was trying to explain that you are the people who are creating the brightest mind of the country, and you are the people who are creating the brightest mind who will become leaders of tomorrow. So if they don't have an understanding of sustainability, if they don't understand what is sustainability mindset is, who will bring the change? They are the agents of change. So I mean, sustainability should be taught not only the finance professionals, accounting professionals, commerce professionals, but in general all professionals, because sustainability is not a cake that can be ate by only one stream. It's a cake which has to be divided and shared and eaten by all. Then only the success of it comes. With this, I would like to again bounce on the fact that sustainability is very important, and sustainability is important especially for this generation. I mean, because I expect new chartered accountants, new engineers, new MBAs who join the corporate, they have to bring the change. They in corporate people of 50, 60 will be sitting. They may not be too much aware of sustainability. They have a fixed mindset. They have to bring the way. They are the winds of change. They have to create a change. So the responsibility is there in this generation, and also the people who are attending this course. I'm presuming a lot of young people are attending. I'm presuming a lot of auditors are attending. For auditors also, see if people have to disclose data, it has to be assured. The big question is, can we put our hands up and say yes, we are ready for giving assurance. I feel most cases answer is no. Let's be honest. Let me keep a hand on a heart and say the answer is no. Because for that you need a proper education, which possibly CA curriculum does not give. Thanks to ICI, thanks to our sustainability board of ICI, they have started a lot of courses on sustainability. They have having so much awareness program. They have been providing a lot of webinars opportunities for people. So it definitely creates awareness. But it's up to us to.
Sir, you have gone on mute. Raj sir?
Yeah.
Yeah.
Okay. So certification is only one part of the story. If you want to do certification, you want to add a line of revenue, which will be a very big chunk in future. So you have to work hard. You have to build competencies, and I mean we can only fulfill our ambition if we work towards it. So my request to all the people who are on the other side of the table, because I'm in corporate, who are on the auditing side, please build competencies in your firm, and I can assure you, otherwise you will miss the bus of sustainability bus. With this, I think I will come to an end to this session. But happy to take questions. We have some time to take questions, to deliberate and discuss. So over to you.
Thank you. Yeah. Thank you, Raj sir. Thank you very much. And it was indeed an insightful and deliberating presentation by all the four participants, started by you and then Samriddhi and Mithika as well as Moni. I'm really thankful, and it was something that I've also learned in the process. So let me just take up the questions that has come up at our end. Friends, you can keep pouring the questions. Raj sir is here, and we should have this. My first question is on when you have such comprehensive framework integrated reporting, then on of integrated reporting, then why should we consider IFRS S1? So I think Mithika, you would answer on this. Why should we consider IFRS S1 when we already have a comprehensive standards, integrated standards out here?
If you can you hear me clearly, Puneet?
Yes, yes, yeah.
Okay. So I'll just continue on here only. That's actually a very powerful question. The difference between IR and IFRS is just that the IR does not give you key indicators against which you can disclose your information, right? What that means is the integrated reporting framework is giving you 6 capitals as broad guidelines against which you can give qualitative disclosure, and that would also be acceptable by the framework. Now, but having said that, IFRS does not tell you where you need to disclose the 50 plus disclosure requirements that are mentioned under S1 and 50 plus in S2. It just tells you that, okay, in some platform, annually you must disclose. What most companies we are expecting would do next year is they would publish possibly an integrated report under which they will integrate IFRS S1 S2. Right?
Okay.
So what the good bit here is the IR is broad enough for you to include both qualitative and quantitative indicators, which means the company has a better scope to disclose a narrative or a storyline which is important for the company. And IFRS S1 S2 gives you the quantitative measures against which you can measure your progress while disclosing your story at best.
Yes, I got it. I think the next question is to Miss Moni or Raj sir. I think who would like to take it. It is like, what would be the responsibility of the auditor conducting a BRSR in the event of greenwashing by the company? Moni, you'll have to unmute yourself, probably. Yep. You're still not audible, Moni.
Can you hear me now?
Yep.
Okay. So, this is my first time, and I'm actually right now in the team where we are. Our role is as auditing. So, first time I'm playing a role of auditing. So, what I learned being a chartered accountant, it's not just about getting the technical knowledge. it's about checking the knowledge with the information which is provided by the client. In financial statements also, the clients provides us all the data and we have to check. There are different standards, there are different regulations. We need to check that is it complying with that. So in BRSR also there are a lot of standards and they are evolving. So first of all, of course, we need to understand them. We must have the knowledge, and of course, we need to keep us updated from time to time, because it is, it's a very changing field. Every day anything new is coming. Like in for auditing also there is one standard ISSA, especially for this sustainability audit assurance is coming. So, being auditor, what we can do is we can play a big role in looking at the compliance part. And when we see the technical things, the emission and all, what I learned is that there are already standards which the engineers are, taking care of. They are calculating the emissions based on that. We just need to see, are those standards appropriate? Are they authentic? And whether the management is complying with those standards properly, are the calculations proper. So I think being chartered accountants, we are already aware, how to check the accuracy and of the data. So yes, we can, being auditor, we can play big role in ESG reporting as well. Thank you, sir.
Yes. So
I
the
think
liability, yeah, yeah,
I'll just like to add. I
yes,
mean,
Raj sir.
what Moni has answered, that's absolutely correct. He has gone to the granular level what auditor needs to do. But I would like to tell something different. We chartered accountants has a bigger role than that. If as a chartered accountant, if I say some company doing window dressing, so where is the window dressing concept started? Is it at the lower level or is it at the board level or senior level? The answer is senior level. The senior management must have instructed or they must have played a role. They must have spoken to accountants or and etc. And they have initiated that. Okay. So even greenwashing also, it will start on the top. So for that, the importance is change of mindset. And where chartered accountants who are at the board, at the leadership level, young chartered accountants who will be working with the CEOs and the CFOs and the board of directors in director's office, I think we play a major role in actually bringing the winds of change, explaining the people. Even if sometimes we are very excited and in the lure of showing some achievements, we do some mistakes. It is us to also play a role of conscious keeper. So we always been a role of conscious keeper. Here also, I think this role is very much on our head.
Okay. Yeah. So the responsibility, or I mean, in terms of in the event of greenwashing, auditor is also equally responsible. That's what you want to highlight. Okay? It should not be.
Of course, I mean,
Yeah.
the auditor is auditing the data, and if there's a greenwashing element in the data, so auditors should have a competence to find it out, identify it, and report it accordingly. Otherwise, I have to say they are not doing the job correctly.
Okay. Okay. Right. Correct, sir. Taking it further, you said that on whose shoulder the sustainability monkey is going to rest, and this the same question which has come up is that who is to take the respectability for the correctness of the BRSR report? Is the board, CFO, or the compliance officer? Who would be the final authority on which who would ensure that correctness of BRSR reports are taken?
So I will take this question. So
Yeah. Yeah.
basically, it's a governance-related question ultimately. So ultimately, what happens in the organization? BRSR report is prepared by many. The data is, there are 9 principles. Data is required to be prepared by the various departments, HR, company secretary, business, finance, and whatnot. And those are there must be central team will compile the data. There must leadership team will go through data and sign off. And ultimately, there is a apex committee. In most of the big companies we have now, ESG committee or sustainability committee. So the board of directors, the members of the sustainability committees are experts. So they validate, and ultimately when they sign off, the data goes up. So it's a responsibility of the leadership. I mean, you cannot the company leadership cannot say, oh well, there are few experts sitting in the sustainability committee and ESG committee. They have approved it, so it's fine. So the responsibility is very much there. At the same time, the people in the board and or audit committee or sustainability committee cannot say, well, it is done by company executive and we trust them, so we need not look deep into it. No, it's a joint responsibility. So if there is something of that sort, well, it has to be the responsibility of the leadership as well as the governance, that is the governance to board or sustainability committee.
Right. So I get your point, friends. It is a collective responsibility. Of course, board, CFO, and compliance officer, all three would be equally responsible for the correctness of the BRSR reports. True. Sir, there is one more question, and I think it is again to Mitika. Is that how do we report if there are operations across many countries, especially when IFRS IS1 has to be adopted?
Sorry, Puneet, could we trouble you to repeat that question? Across many countries.
Operations, if there are operations across many countries, and how should be the IFRS S1 be reported? That's what the question is coming up. So if it is only in India, so you have a comparable and you can have a joint report. But if there are multiple countries which are involved, so how that has to be adopted? Probably that is a question.
Right. So IFRS is actually very smart that way. While I'm saying they've only asked for 50 plus disclosures, they've given a little over 6 PDF files as guidance as to how you can do something like this. Of course, going through all of it is quite the task. What they've also done is for each sector, they've customized the kind of questions you could be answering. Not all sectors are, of course, covered in the initial draft, but you'll see that gradually increasing. Just to answer the location question in this context, number one, you first define the boundary of your IFRS reporting. They've given you the option of doing standalone or consolidated. If you're doing one, that doesn't mean you can't do the other. Of course, that just means that you've chosen the boundary for reporting in this context. Most people, as they have started out with BRSR, you tend to see standalone disclosures as and when more maturity comes within the market and as and when more sort of consistency comes within reporting, you will start seeing more consolidated disclosures. Having said that, what we've also seen in the past in trends with the integrated report is that organizations that are primarily based in Europe and Sub-Saharan Africa, because they follow similar reporting frameworks, chose to go ahead with consolidated reporting in the integrated reporting format because there was some flexibility for qualitative information. IFRS is also offering some flexibility for qualitative information, and wherein you can mention that over a span of 3 years or the next 3 years or the next 5 years, we will give more quantitative information regarding this. However, we started, say, a scenario analysis in the context of climate change or a materiality exercise in the context of S1 in the sustainability section of IFRS. So you have the flexibility initially, even if you are choosing to go ahead with consolidated, to give qualitative disclosures upfront in the beginning. Now, how you choose on location, it should ideally start off with what you define as your material boundary, right? Even within your consolidated entity, you should ideally choose the one that is contributing to maximum amount of sustainability or climate-related impacts, right? And within those impacts, you also further need to define materiality for each KPI. Key performance indicator. So say, for example, if water is your material topic, whether or not water withdrawal is a topic, water discharge is a material topic, or it is just the entire water management, which is also known as water balance. Which of these is a material topic for you? And within that, which is a material indicator such that when you're giving the quantitative numbers, it's still coming up to 90%. So say, for example, can you let go of, then you ask yourself in the materiality within KPI kind of questions, can you let go of drinking water for employees if majority of your operations is, say, manufacturing? Right? Wherein, say, for example, you're using millions and millions of liters of water in operations, but for an employee, you're probably providing 1 liter of water a day. Does that become material? And that, in the context of quantitative materiality, is the next step that IFRS is asking, and that's where you need to granularize where your aspects are. Again, GRI and IFRS have very similar definitions of location materiality currently. At least so far, what we've seen in the IFRS S1 S2 standards, they define materiality in terms of location basis that your key manufacturing locations or your key contributing locations must be included. Your head office must be included. Your operations in terms of the country of registration must be included. Now, beyond that, you can always add certain levels of disclosure, saying we are going to start with, say, 5 countries, and then we're going to expand to the remaining 10, and so on and so forth. So that can become a gradual process when you move ahead with locations.
Wonderful, wonderful, Mithika. You've actually answered the question quite in detail. And there is similar question which has come up. I think we have answered on that. If you could just confirm difference between materiality and material misstatement.
So this
Yeah.
is actually more technical, and we haven't covered it actually.
Okay, we've not covered.
Right. There are 6 guidance documents, and I think all of us are in the room wondering the same thing as to how much detail we should get into for this.
No, I understand.
Material
Yeah.
misstatement is the last aspect of your assurance statement, wherein you're claiming uncertainty and what percentage of the data you're comfortable. Most likely, as I think Moni also mentioned, ISA 3000, which is the ISA 3000 standards that globally people are considering, which will gradually move to ISA 5000, which is sustainability specific with time. In the end of the ISA 3000 or AASA, which is the Australian standard, or SAS, which is the more recent ones that are also being adopted by one of the big fours, in the end, you have a section right after scope wherein you have to define uncertainties and what is it that you consider as material misstatement in that, in the sense that I'm covering a certain scope, and that again, within the guidance document, you get more of the technical details as that you can actually execute it better as auditors. But understand materiality just broadly. I'm telling you, materiality is something that happens before you start the audit. Material misstatement is essentially something that happens after you've completed the audit. That's the easiest way you can start with your, distinguishing this.
Fantastic, fantastic. So next question is probably for Raj sir again. How do we ensure that various policies mentioned in BRSR reports are efficiently implemented? Do we need to have, or is there an ERP system to track it, or you have any suggested method to track? So how do we track at Reliance? Probably you can discuss on that. And what are the things that as a chartered accountants can do for ensuring that the various policies mentioned in the BRSR are efficiently implemented? Some basic things, if you can just give overall guidelines.
Yes, sure. So basically, how it happens or how it exactly corporates work. So first of all, a policy is formulated. So when policy is formulated, it is people at the base level are involved. It goes to the layer above that. Ultimately, leadership, it is signed off, and then if there's a board committee, it goes to the board committee, it gets the blessing of the board committee, and you have policy in place. That's the first thing, right? So now, after a policy is in place, it goes in the framework of the company. Every company has a governance framework, so where the policies has to be stored. So if you come to Reliance and you tell me a policy, so I will not look into things. I will take you to a website or portal where you click. You will have various departments and various policies there. First of all, that governance has to be there, wherein you have the policies. Otherwise, I mean, policies will be there. It is in the drawer of someone or someone's laptop, and people will forget it. And we know how people are forgetful. That's human nature. So first the governance is there. Once the governance is there, and this policy has to break down various steps of when someone has to audit or someone has to see the trail, the policies has to vary on various activities, right? And various control points. Those control points need to be evaluated. So when a person does any transaction or activity, normally we have the make in RIL, we have, it's very famous now, we have the maker checker concept and LOD1, LOD2, LOD3 concept, right? So LOD stands for line of defense. Line of defense 1, line of defense 2, line of defense 3. Maker checker concept means whatever a person do, there is always a checker. Okay, he also takes joint responsibility. He will check. LOD1, LOD2, LOD3 means there's a line of defense 1, a person who actually executes the transaction. There's line of defense 2, a person who will validate a transaction. LOD3, normally we have internal audit. Somewhere we have LOD4 also. At the each level, there's a check, and ultimately the internal audit will do, right? So now the question is whether this policy and control points will be evaluated by the auditors or not. That's a different issue. But it is a responsibility of the company, the executive, to have a setup, a system where the policies are monitored and are actually re-regulated, the control points are evaluated.
Absolutely. So, do we have an ERP system to do it, or it is in-house software that has been done? I mean, just
Yeah. So whatever policy you have, we have two kind of it is bucketed or categorized on two heads. One is a policy which is digitized, and one policy is manual. Everything you cannot have digitized. In RIL, we have 60-70% of policies being digitized. Okay. So
fantastic.
there is salary policy, there is other policy. There's some policies there which is which can be digitized. For example, when there is delegation of authority, when I go out and speak in public, I need to take a concurrence of our some delegation of authorities there who will give the concurrence. So that in our system it is not digitized. It is manual. I do this through mails or through phone calls, whatever it is done. So it's a manual thing. Other things where financial numbers or etc. concerned, it is completely digitized.
Okay. Okay. Think we are covering almost all the questions. Friends, someone has asked where do we learn it? CA Institute, our ICI is already conducting a course on sustainability. So you can, and it is currently going on with about 210 participants. Preeti ma'am just spoke right at the beginning of the session. So you can get more input from the ICI website as well on the sustainability course. So that is there. And I think we can take up a last question. Do we need to give a roadmap for 169 targets of SDGs, especially if the company is committed to achieve by 2030, achieve in 2030? So do we need to give a roadmap for all the 169 targets of SDG? Raj sir?
Okay, fine. First of all, that if you have a commitment, then you need to have a roadmap. That's the first one. So you say, okay, I will achieve there after 5 years. So what you want to do, what are the activities you want to do, and what are the timeline of activities to achieve that destination or arrive at destination, you need to have a target yourself. Now the question is whether these targets be communicated or not. Well, in some places it is mandated, statutorily required, so there you have to give. In most cases, it is not mandatorily required, but it's a fair point. It's a good practice to do it. Now the things have slightly changed. If you're not giving the milestones and your achievement against the milestones, people are criticizing you are getting less marks by the or your rating is coming down. So this is one of the aspects. So now more and more people, whatever announcement they are making of targets, they are somewhat encouraged. I can say encouraged is a very positive word. I would like to use the word encouraged to give targets and milestones and their achievement against the milestone year to year based on periodic basis.
Okay. Nice. I think most of the questions have been covered. Those which are related to our sessions has been covered, and I'm really thankful to Rajbhai and the entire team of Reliance, Mithika, Moni, Samriddhi. All of you have taken up the session today with great insightful deliberation, and it was really a pleasure. So on behalf of Institute of Chartered Accountants of India and Sustainable SRSB Board, I, CA Puneet Mehta, thank you all of you for taking out your time and giving our members. There are 450 members who have been listening to you, all of you, and learning about how we can move forward on this sustainability area. Sustainability, as rightly said by all of us, Preeti ma'am also at the start, that it's all pervasive. It is not just one reporting, but it is all pervasive. And the way in which we have taken up, I think it will go and help our members a long way and give them good inputs and insights into their work. So with those words, I thank all of you to be present and give your deliberations. Thank you, Raj sir. Thank you, Mithika Bajaj. Thank you, Moni. Thank you, Samriddhi.
Thanks, Puneet. Me and on
Pleasure.
behalf of the entire team, I want to thank you. It's Mithika Bajpayee, Moni Bajaj, and Samriddhi. So on behalf of all of us, thanks Institute for conducting sessions. It is very heartening to see. It's very encouraging to see more than 450 people are on the call. Well,
Yes.
we will definitely have more chartered accountants in the sustainability space. That's for sure. Thank you. Thanks a lot.
Sure. Pleasure. Thank you. Right.